I'm Sankalpo from PMS World, and I take care of business development here. Today we have Nishit of Phillip Capital with us. So we'll come, to the presentation. But let me just introduce Nishit first. So Nishit is one of the most experienced fund managers around, and he has close to 15 years of experience. He is a triple masters in finance and management, and he brings with himself an experience of working on both buy side and sell side roles, which gives him that unique knack of knowing just what investors want. And in that pursuit, today we will discuss his multi-asset investment strategy, which is quite close to our heart also, because we have always talked about asset allocation in a lot of our previous talks. And with that in mind, before I hand over the floor to Nishit, let me just update a lot of our listeners on what has been happening in the Indian macro front. So why I chose macro is because we get worried जब मार्केट 3-4 दिन लगातार ऐसा थोड़ा डेट में क्लोज होता है, we get worried. But I think from a economy point of view, macro point of view, we are quite well cushioned. We have 15 months of foreign reserves, so that is close to $500 billion, and that's quite a comforting number. Our reserves are fifth, by the current volume of reserves we hold. That's some good comfort. Also, the rupee has held quite strong compared to other EMs. So that gives a comfort, certain level of comfort to India as an economy, and in context, India as an investment destination. So that is from my side. I won't keep you long. So Nishit, the floor is yours, and the format will be, you first present your slides, and then we'll take a few questions and a few questions from the audience. So over to you.
Okay. Thanks, Sankalpo. Good evening, everyone. And I welcome all of you on this seminar. I thank everyone for taking out time and attending this seminar. Okay. So what I will keep the presentation very fluid. Okay. And then of course, post that we'll also take question and answers. So I'll start with my presentation. And then of course, as I said, that we'll take up questions later on. So these are the topics that we'll talk about. We'll talk about what Phillip Capital is, the investment landscape, importance of diversification, and how Phillip multi-asset portfolio can help in diversification. Okay. So first, let me talk about Phillip Capital. Okay. So that way,
Nishit, there's some disturbance in your line. Sorry to cut in, but there's some disturbance. You can just.
Okay. So I just wanted to give you a kind of a background about Phillip Capital. So Phillip Capital, that way we were a very large global behemoth. We are established in 1975 in Singapore. And we are spread across 15 countries globally. So we are there right across from US to Australia. We are headquartered of Singapore, and in that region we are very huge. Here in India also we are very big. But since we are not much on the retail side of the business, not many people know of us. But if you talk to any institutional client, so maybe an FI, hedge fund, sovereign wealth funds, domestic fund houses, all of them would be knowing us. And the second set of clients that we service is HNI clients. So again, in HNI, right from the largest of the HNI clients to many of your discrete HNI clients like you, they are our clients. Now, having said that, of course, we deal with this two set of clients. These two set of clients are also very demanding. And that is where here in India, research is a backbone kind of a thing. Okay. So we have a 25-member institutional research team. All of them are quite experienced, plus 10 years of experience, highly rated. And we are very well known to providing the cutting edge research and also a lot of ground level research. Okay. So globally, of course, we manage close to around $47 billion in the asset and custody. Of course, we have got more than 1.3 million clients globally. And of course, our shareholders fund is also in excess of $1.5 billion. So that is about Phillip Capital. So now let's move to the team at PMS at Phillip Capital out here. So of course, Vineet Bhatnagar, who's our MD and CEO. He himself is part of the team, and Rajendra Bhambani, who's the joint MD. So why is the senior management also involved in the fund management of the PMS is because it's a serious business. Yeah, the minimum ticket size is now, of course, 50 lakhs. 25 lakh itself was big, 50 lakhs. So this is serious money. Yeah, so that's why the senior management is also involved in it, because we think that, oh, this, it's a very big responsibility when someone is trusting us with their money. Yeah, so that is why we, of course, we have a lot of disciplines that we follow. Of course, it's a research driven process, but at the same time, Vineet and Raj themselves are part of the team. Now coming to the investment landscape. Yeah, see, when I talk about which is the best asset class, yeah, people always say, oh, the Indian equities would have given the best kind of returns. But if you go to see, yeah, since 2007, April 2007 till November 2020, and of course, we have just not updated the slides for the last couple of months, but this holds true for last 2 months as well. Yeah, over this period, Nifty has given a CAGR return of only 9.3%. Yeah, against that, gold has given a return of around 11.7. Yeah, S&P 500 has given a return of 10.3, and debt, yeah, so we have taken an example of Bharat bonds, has given a return of 9.4%. Yeah, so if you go to see return wise, yeah, that is the first, and I'm talking about long term. Yeah, 2007 to 2020 is a 13-14 years kind of thing. Yeah, so this is good long term enough. Yeah, but if you go to see, Indian markets have not given that great a return. And at the same time, volatility and drawdowns are also very big as far as the Indian markets are concerned. Yeah, of course, here I am talking about Nifty, but it holds true across all other benchmarks as well, indices here in India. Yeah, so volatility is, for suppose for Nifty is 22%. The worst drawdown which had come in 2008 was close to around 60%. Gold, compared to that, the volatility in gold is around 15%. The drawdowns, the worst drawdown was only 27, 28%. Yeah, S&P 500, the worst volatility is 20%. Yeah, and of course, debt, the volatility and the drawdowns are always lesser, but kind of thing. But what I wanted to showcase is that it is not necessary that equity markets give the best return. Of course, there are two thoughts out here. One, of course, there's a very big global debate, and maybe it's also a lot in focus, is that passive investments, that you invest into ETF, okay, and then, but here in India, I would say passive investment would not work. Okay, of course, active fund management would work, kind of thing, and returns would improve. But as far as passive fund management is concerned, or maybe a normal retail or a normal HNI client is concerned, he would have not made any returns better than this kind of thing. Yeah, and of course, money making itself has been very difficult over last 10 to 15 years. Yeah, it is only since last 4-5 months that we have seen a big kind of uptick in the markets, and all of us are gung-ho. But overall, if you take long term, money making in Indian equity markets has not been that great. Of course, and this is true across all asset classes. Yeah, there have been bouts of extreme volatility and everything kind of thing. Of course, for at the end of the day, all of our eternal optimist, yeah, we always feel that Indian equity markets would give the best return kind of thing. But what is the main concern out here is the volatility and the drawdown that the Indian equity markets get. You'll keep on hearing these two words throughout the presentation kind of thing. Yeah, so volatility and drawdown. So what I wanted to say here is the crux of this slide is that no single asset can deliver everything an investor wants. Okay, now let's shift to the next slide. Okay, now again, this is one of my favorite slides. So what we have tried to compare out here is when Indian markets give a negative return over a 12 month, on an average 12 month, whenever they give a negative return, what are the returns of other asset classes? Okay, so what we have compared out here over last 15 years, whenever Nifty has given a negative return, what is the return of other asset classes during that time? Yeah, so when Nifty was down minus 14%, and during that time gold was plus 25%. Yeah, S&P 500 was again not big, but at least it was in positive territory, and of course debt was plus 10% kind of thing. Yeah, again, if you move from 12 months to 36 months, kind of a 3 years, whenever Nifty on a rolling 3-year basis has given a negative return, yeah, here the maximum drawdown was minus 1%, but during that same time gold had given a plus 17% return, S&P 500 had given us a 11% return, and of course Bharat bonds, which is a proxy for debt has given us 8.5%. Yeah. So what the only saving grace has been, there's no correlation or low correlation between the asset classes. Yeah, especially with Indian Nifty and gold and Indian Nifty and debt kind of thing. So whenever Indian markets are down, gold and debt is a savior kind of thing. Okay. So, and this is a very important point. Over last 13 years, Nifty on a rolling 12-month basis has given a negative return 25% of times, yeah, with an average return of 15% But during those same period, yeah, gold and international equities have outperformed. Okay, so diversification helps, but especially on the downside. Yeah, so if you diversify, it always helps, but especially it helps when Indian markets are on the downside kind of thing. So that is what I wanted to bring out of from this slide. Yeah. So now let's take a very simple example. Yeah, let's do a simple diversification. Okay, and let's see what happens as far as yeah.
Sorry to disturb you again. Can you just remove your earphones? I think उसकी वजह से थोड़ा disturbance आ रहा है. And just use the computer microphone if you can.
Yeah. Can you hear me now?
Yeah.
Okay. So what in this slide we have done is, we have taken a very simple kind of a diversification. So what we are asking, let's divide your 100 rupees, wherein out of that 100 rupees, 50 rupees you invest into Nifty 50. Okay, 20 rupees you invest into gold ETF. 10 rupees you invest into S&P 500 ETF, and 20 rupees you invest into debt. Now, what will happen to your returns? Okay, that is what we want to compare kind of thing. Okay, so if you go and see, Nifty during this last 13 years, if you would have done, if you have not diversified, it would have given you a CAGR returns of only 9.3%. But if you would have done this simple diversification, 50, 20, 10, 20 kind of thing, your returns would have jumped up to 11%. Yeah, now some of you might feel, only 2% jump, but this 2% CAGR return is over 13 to 14 years period, which is a very big, we are talking about very big number. Yeah, and again, of course, you would have done much better than what Nifty itself would have done kind of thing. Okay, and you look at, volatility is coming down from 22%, it is coming down to only 11.8%, and drawdowns. Yeah, so suppose your 100 rupees in 2008 would have become only 40 rupees. Yeah, but here it would have become only 65 rupees. Yeah, so that is what I wanted to get. So diversification is the way going ahead. Yeah, see, of course, as I told you earlier, either you go in for an active fund management. Of course, we also have got few strategies on that side, and we have been doing quite well. Otherwise, if you don't kind of think that, if you are planning to do passive investments, or maybe just invest into an ETF, average mutual fund, in that case, diversification would surely help. Yeah. So why I wanted to get this slide is that I wanted to show you by just doing normal, simple diversification, in fact, you are beating the Nifty returns. Okay. Now let's see what is the main reason of the drawdown. Yeah. So diversification impact on the drawdown. Yeah. So we have taken 3 periods basically, wherein we have seen a very big downside in the Indian markets. One was, of course, 2008. Second was, of course, during recent January to March 2020, which all of us remember because of the pandemic. And one was, of course, November 10 to December 11. That time we had seen a kind of a big drawdown in the market. So during 2008, we had seen a correction of close to around 60% in the markets. Yeah, but if you would have just kind of done a simple diversification, your portfolio would have fallen down to only by 34% kind of thing. Yeah, and again, during this current period when Nifty fell down by 38%, if you would have just kind of done simple diversification, your portfolio would have fallen down by only 22%. Yeah, and this is more important. See the recovery days. In 2008, it would have taken you close to around 2 years plus kind of to recover. Yes, what the drawdown means, whenever you invest 100 rupees, say suppose the drawdown is 59%. Okay, so 60%. So your 100 rupees would have become 40 rupees. Yeah, so it would have again taken 2 years for that 40 rupees to become 100 rupees. Yeah, but here in simple diversification, it would have taken less than 1 year to kind of jump back to your 100 rupees. Yeah, so that is so simple diversification not only reduces drawdown, but it also ensures that portfolio recovers much faster. Yeah, so that is what this slide emphasizes on. Yeah. So now let's see what is the source of the drawdown. So when you do simple diversification, yeah, what is in fact taking this 34% down? So suppose when you're doing simple diversification, your portfolio in 2008 would have come down by 34% down. Yeah, but what is the source of this drawdown? So again, our Indian markets was the biggest source of the drawdown. Yeah, out of this 34%, close around 60%, the drawdown was led by Indian markets. Yeah, of course, gold at that time was positive, so that's why it's showing here negative -1%. S&P 500 contributed close to around 20% to the drawdown, and of course, again, Bharat bonds was plus kind of thing. So that's why. Yeah. So again, if you see the culprit at each of the instances, yeah, it is the Indian markets which has been the biggest reason for the drawdown kind of thing. Okay, so what we want to get here, controlling equity volatility and drawdown is also key to controlling the portfolio volatility and drawdown. Yeah, so it is not only necessary to diversify, but if you want to enhance your return, you also need to manage the volatility and the drawdown that the Indian equity markets get. Yeah, so that is where, of course, we come into picture. Yeah. Yeah, so this is what, yeah, this is where Phillip multi-asset portfolio comes. So what we do out here, of course, we do the simple diversification wherein we invest close to around 50% into Indian equities, 20% into gold, 10% into international equities, and 20% into fixed income. But what at the same time that we do, we saw that in the previous slide, that Indian market was one of the biggest reason for the drawdown. So what we do, we have developed our in-house algos, okay, which gives us buy signal and sell signal as far as the Indian markets are concerned. Okay, so what does it does? It tells us that, okay, now this is the time to sell off and sit on cash as far as your 50% allocation to Indian markets is concerned. Yeah, and this is the time to invest back kind of thing. Okay, so what we are doing by doing this thing, yeah, we are trying to manage the volatility kind of thing. And maybe some people can say we are trying to time the markets. All of us know no one can time the markets, but the idea out here is that even if we are able to capture that 60-70% of the timing of the markets, we are much better off kind of thing. Yeah? And that is what this entire strategy hinges on. Okay. So as I told you, it's a very simple kind of thing. Okay, so there are two parts to the strategy. Okay, 50% allocation, which is to the Indian equities, that is dynamically managed. Okay, there's entry and exit. Again, the churn ratio is not going to be big kind of thing, and we have back tested this over last 20 years kind of thing. Overall, maybe this 50% of the portfolio, maybe 2 to 3 times the churn a year. That is the kind of churn that we are looking at. Okay, so we are not talking about big churns kind of thing. And the rest 50% of the portfolio, wherein 10% is into international equities, 20% into gold, and 20% into fixed income, this is static in nature. Yeah, of course, this can also be dynamic, but maybe once in 2-3 years, we might have to change the allocation there a little bit. Otherwise, 50% of the allocation to Indian equities is very dynamic in nature. The rest 50% is static. Okay, so now let's see what happens. Okay. So yeah, so we have seen this before, that if you don't diversify, if you just invest in Nifty, if you had invested in 2018, yeah, till November 2020, your returns would have been 9.3% CAGR returns. If you do a simple diversification, yeah, your returns are 11%. But if you would have invested into Phillip multi-asset strategy, your returns would jump to 12.4%. Yeah, and see, this is where the beauty lies. Yeah, the volatility. Yeah, the volatility in Nifty would have been close to around 22%. In simple multi-asset, it would have been 11%. But here in a Phillip multi-asset portfolio, it is only 9%. Yeah, and the drawdowns also, you see the numbers. Yeah, in 2008, the drawdown was 60%. Here 34%, but here drawdown is only 13%. Yeah, see why volatility and drawdowns are important. Yeah, see, lesser your portfolio falls down, the better the chances to bounce back. Yeah, so as I told you, in 2008, your 100 rupees would have become 40 rupees. Yeah, so it takes that much longer time to bounce back kind of thing. Yeah, but if your 100 rupees has become only 90 rupees, yeah, then the chances are that your portfolio will bounce back earlier. Okay. And what is the meaning of volatility? I don't want to go into technical definition kind of thing, but volatility gets a lot of heartburn, heartaches for the investors. Okay. When they see markets falling down, they want to sell off everything. Yeah. Or when markets are going high, they want to invest more kind of thing. So there's a lot of sentiment involved. Yeah. So when your volatility itself is down, yeah, so that heartburn or heartache is not there. Oh, now I want to exit, or now I want to invest more kind of thing. So that is what, if the volatility is down, yeah. So how all of us don't look at the kind of returns an FD gives on a daily basis, but we look at returns that an equity markets provide on a daily basis. Yeah. So this strategy is kind of to get that heartburn, heartache now, but by not compromising on the returns. In fact, the returns are better. Yeah. So that is what this strategy is all about, kind of. Okay. So now let's look at the same slide, what we had seen, Nifty, simple multi-asset portfolio, which we have already discussed. Now let's look at this, and let's take 2008 as our example. Okay. So suppose in Nifty, in 2008, the portfolio would have fallen down by 59%. Here it would have fallen by 34%, but here it would have fallen by only 13%. Okay. Or let's take a recent example. Okay. So yeah, in 2020 in March, when we saw the big fall. So actually this our algos gave us a sell signal at around third week of February. Okay. So that is where we sold off the 50% that was invested into Indian equity markets. We sold off and we invested into liquid funds. Okay. And again, this particular algo gave us a buy signal at around fourth week of April. Yeah. So we sold off the liquid funds and again invested back. Yeah. So as I told you, this is not a perfect kind of a timing, yeah, because you would have missed the first 3-4 weeks of the rally which came in April month. But yeah, again, we kind of avoided the big downfall that had come in March itself. Yeah. So let's see. Yeah. Here in Nifty, the downfall was 38%. In simple diversified portfolio, the downfall was 22%. But here the downfall was only close to around 10%. Yeah. So your 100 rupees would have become only 90 rupees. Here your 100 rupees would have become close to around 60 rupees kind of thing. Yeah? So that is what I'm telling you. Yeah. So once volatility and drawdowns themselves come down, yeah, you would be much more peaceful kind of thing. And of course, you're giving your portfolio to do much better. Yeah. Otherwise, and this happens across not only into direct stocks. If you have invested into any mutual funds or PMS, how much ever the fund manager or the salesperson would have tell you, but that panic comes into all of us kind of thing. Yeah. So this strategy is ideally suited for those kind of people. Yeah. So why Phillip multi-asset portfolio? So it's a diversified multi-asset portfolio that gives investors protection during economic distress, significantly limits drawdowns. Okay. Low correlation across asset classes, dynamic equity allocation. Yeah. This is very. Yes, maybe we'll get a question going forward that how different it is from the few of the multi-asset strategies that few of the mutual fund houses have launched. So this is the main, yeah. All of them are passive in nature, yeah. So of course they would do better, but if it is dynamically managed, your returns would be much better, yeah. Yeah, and of course we can also customize the portfolio, yeah. So we are coming back to whom this strategy is ideally suited to. Yeah, this strategy is ideally suited for people or investors or prospects who at current market valuations are not comfortable. Yeah, they say, oh, markets have ran up too much. Yeah, how can I invest at current valuations, kind of thing. So this strategy is for them. The second set of investors, the strategy is very much suitable is, so suppose who have been investing into fixed income products, okay, pure fixed income products, FDs, debt funds, and all those things, okay. But now with lowering of interest rates, they're not happy with the returns. But at the same time, they're scared of the volatility or the heartache that Indian equity markets get. So this product is suited for them. So you're getting returns better than your fixed income products, but volatility, it is avoiding the volatility that the Indian markets get. Yeah. Or third, yeah, it is actually ideally suited for everyone. Yeah. Because we have seen that diversification helps, kind of thing. Okay. So, and I've seen that normal investors, we are not able to diversify. The maximum diversification that we do, we buy real estate, and then we invest into stocks, or maybe some of them would be invest into gold, but of course that is for different purpose. It is not actually for as an investment kind of thing. So this is the three set of that this is quite suited to. Now just to give you a flavor about all our other strategies as well. So all our other strategies are actively managed, they are research driven. So I am not saying that multi-asset is better than actively managed, but as I told you, this is more suited for people who have invested into fixed income or don't want the volatility of equity markets. That is what, of course, a pure research driven which invests into good quality stocks would always outperform anything else over long term basis, but a multi-asset strategy would work for mostly, I would say, more than 70% of the investors kind of thing. So these are just, of course, few of the fun details that we need to go through. As I told you, investment objective is to generate superior returns over long term by investing into multi-asset or across asset classes. We benchmark ourselves with what exactly that we are doing kind of thing. So this is what we benchmark ourselves kind of thing. It's a customized benchmark indices that we have formed. And the minimum investment tenure that we are looking at is around 3 years plus kind of thing. So that is what we are looking at. And as far as, of course, there are no assurance or guarantee in any of our PMS strategies, especially this one as well. So if I've given any indication or something, but please do your due diligence and then invest into any of the investment product kind of thing. So Sankalp, I am done kind of thing. We've just run through the disclaimer. And then
thank you, Nishit. Thank you. So again, let me just give up the disclaimer loud and clear that this is more of an educational purpose, and please, like Nishit said, do your own due diligence before you invest on anything discussed here. So okay, thank you, Nishit. So I'll just give you a context. We just ran a poll while you were presenting that like how many asset classes are there in the portfolio of investors who logged in today. So only 16% said that they have only one asset class, that is only equities for 16%. The other 83%, are divided between 3 to 4 asset classes, including asset classes like alternates, bitcoins and private equity. And in one of our previous sessions, we had the opportunity to host Karan Bhagat. So he also somewhere said that what is more important for investors or clients is that you manage volatility first and then you look out for return. So I take your point, which you made last at the end. My question is a little bit more, it's a little different from this. So why does a investor or a client come to a fund manager for asset allocation per se? Okay. So this is something at the portfolio level. Typically in India, so far the practice has been you give the mandate to a fund manager to do a bottoms-up kind of equity investing or a credit kind of situation or something like that. So what is your pitch when you say that आप हमसे asset allocation के लिए आइए सलाह मांगिए? So
sure. Of course. See, of course, that's a great question, Sankalp. See, of course, as I told earlier, if you invest into stocks which are good quality, bottoms-up approach, that would tend to do well. But what we have seen when it comes to diversification, clients do not diversify that well. See, as we know, most of the guys would have invested into real estate or maybe a little bit into gold, but that proper scientifically based diversification is not there. Sometimes they might go overboard, sometimes they will not invest much into equities. So that when you leave it to an expert, that is where it will kind of give better returns kind of thing. Otherwise your sentiments will come to play. Maybe some of the other reason that they will never be able to go down that diversification line quite in a big way. There would always be kind of disturbance. So that's why actually you need to go to a professional fund manager. Of course you can go to an advisor or something. But as I told you, our product is actually, it's not only simple diversification, we are going a step ahead and getting the volatility and drawdowns much lesser as well. So that is actually the beauty of this product. It is not only, as we had seen in the previous slide, is that simple diversification helps, but when you also manage the volatility further, yeah, that is where your returns also become much better.
What I want to ask next is, hello. Yeah. What my next question to you is essentially, so a follow up to the previous question. So, is your asset allocation dynamic? Is there a dynamic call, or you maintain those? And the second part to the question is actually the next question is. So, you mentioned that making money in equities is getting tougher, but if anything, the last 1 year has been something contra to that. Equity was kind of money out there. Markets bottomed at 7,500 and then kind of doubled from there at the index level. So people have seen money being made in equities. So in your view, what is causing this? What has caused this rally? And are there any like when we're talking of a multi-asset, since equity is in a kind of a seems like a structural bull run, what is your call to action to divest from equities and look at a multi-asset kind of a thing, and what will your fund do when, let's say, if in a situation like the Nifty reaches or on the trajectory to 20,000 from here in the next 6 months or 1 year? So the purpose is to understand how your asset allocation calls work. So over to you.
Sure. Okay. So I'll break your question into multiple parts. So first, as far as the kind of diversification is concerned, is it dynamic or static? Of course, as I told you, 50% of the allocation, which is of course to the Indian equities, that is dynamic in nature. Now, the algos that we have developed take many things into consideration. Okay, it takes into momentum-based parameters, technical parameters, and fundamental parameters. Okay, and based on all these parameters, it gives us either a buy signal or a sell signal. As I told you, it had given us a sell signal at around 3rd week of February 2020. That is the time when we sold off. And again, it gave us a buy signal around 4th week of April 2020, kind of thing. So that is how we had moved in and out of the fund, kind of thing. Okay. Now your second part of the question is, of course, we are in a structural bull run. Will only a pure equity portfolio will not do better than a diversified? Of course, it will do better. But we have seen over long term. See, maybe next 1 or 2 years, we'll see a very big bull run. I am also supremely confident. That is why we have been pushing all our other strategies, Phillip Signature India portfolio and Phillip Emerging India portfolio, which have done much better. We are in the top quartile as a performance is concerned. But as I told you, this is to a different set of investors. Guys who have been investing into FD, they want to invest into equity, but they are worried about the volatility. Okay, or guys maybe who want to invest at current market, but they are worried about the current valuations. So this ideally suited for those kind of investors. Okay, so over next maybe 1 or 2 years, this strategy might underperform a little bit here or there, but the kind of investors who are going to invest in this strategy, they are not worried about next 1 or 2 years returns. And see, again, the 50% itself is going to get invested into equity, Indian equity market. So if markets go up, your portfolio will also do much better, kind of thing. So 50% is in Indian markets, 10% is into S&P 500. So itself 60% out of the 100 rupees is going to go up, kind of thing. Okay, so that is the second part to your question. The third part to your question was, if you can, third part to your question is about the market. What has led the markets to go up and everything. See, of course, and again, you said that in March we have seen a low of around 7,500, but I would want to ask how many investors would have invested all the money that they wanted to invest. See, you look at maybe a guy who had invested in 2016-17, till date his average returns, if he has done passive investments or if he is in a mix of some good stocks, some bad stocks, his return would not have been more than 8 to 10% on a CAGR basis. So we are taking an example of a bottom, and then we are extrapolating. If you had invested in March of 2020, your returns would have been this much. So that, of course, very few of them would have been lucky, or they would have been kind of brave enough to invest a lot of money at those kind of levels. So but of course, we have seen the markets rally. Yeah, this rally has been led by many things. Of course, one of the major thing is liquidity. There was a lot of pent up demand. Results have been coming in good. Yeah, so that way, and we feel that this rally is sustainable. Yeah, of course, we may see a little bit of volatility going ahead. Yeah, we almost jumped 80, 90, 100% from the bottom. We might see a 8 to 10% correction. Here, I would in fact like to. So, I was just yesterday looking at how markets had behaved in the previous bull runs. Okay, so in all the bull runs, suppose the bull run from 2005 to 2008, we had in fact 4 to 5 instances of market correcting by 10 to 20%. Okay, so we are in an upward trajectory, but of course there are certain kind of falls also which we are getting. So we should not be worried about those falls as well. We are very confident that markets would do well over the next 2 to 3 years, and of course, this, as I told you, this is this particular strategy is for a set of investors.
Thank you for the answer. So we've got a couple of questions on how do you do your equity investments. Is it just passive funds? Do you do some active stock picking in the fund, or how's it? Also, while you are at it, can you also kind of guide us or tell us how do you do your fixed income investing? What is the strategy there? So we will combine these.
So I will tell you all the instruments that we are using. So across all the asset classes that we are diversifying, we are using, as of now, we are using only ETF. Okay, so if it is towards Indian equity markets, we are investing into Nifty 50 ETF and Nifty Next 50 ETF. Yeah, so we are getting some kind of an exposure to the mid caps as well. Yeah, so that is as far as the Indian markets are concerned. As far as the international markets are concerned, we are using S&P 500 ETF. The third, for gold, we are using gold ETF, and of course for the debt, as of now, we are using Bharat bonds. Yeah, so all of them are into ETF. So the cost structure itself is very low. As I told you, the churn ratio itself is very low. 50% of the portfolio, of course, is static. The rest 50%, which is little bit dynamically managed, but again, the churn level is not that much kind of a thing. Yeah. So across all asset classes, it is ETF. We are not planning to do any direct equity as of now, because then again, when you start doing direct equity, many things can go right and wrong kind of thing. And this particular product, we want to keep it more of a simple kind of a product, which is low cost and ETF based kind of product.
Thank you. So the way I understand this is a product for someone who doesn't want a lot of volatility on his hands. It's okay doing a low cost ETF based kind of a structure. So point taken. So now,
of course, for another set of who are worried about the current markets, yeah, they feel, oh, markets have ran up too much. How can I invest into current markets? So of course, ideally this is for this two set of clients, and as I told you, third, it is actually for everyone as well who wants to diversify.
Right. Thank you. So that's a well answered question there. The target investor said. Yeah. So what I understand that in your fund you would have taken macro calls. Okay. At some point in time, because it's an asset allocator fund or multi-asset fund, you would have taken macro calls. So right now we are the Indian macros are in a kind of mixed signals kind of a zone. You have the RBI who's being accommodative for way too long, and they are willing to carry the accommodative stance for another financial year per se. Although there are some telltale signs about inflation, the crude being one of the major inflation pullers. So how does this affect a investor in your understanding, and how should it affect allocation from the perspective of an investor as you understand? Over to you, Nishit.
Sure. Okay. Yeah. So of course, now I will be very frank out here, kind of thing, Sarkar. We don't look at macros. Yeah. Say suppose in all our other strategies, which are more fundamental driven kind of thing, again, there also we don't look at macros. Therein we try to focus on individual stocks. Yeah. If stocks, we are confident about the stocks, we would not look much at the macros. In this particular strategy also, we are not looking at macros. Yeah, algo, as I told you, is based on certain parameters, 3 parameters. Yeah, technical parameters, fundamental parameters. So we take P, price to book value kind of thing, and certain momentum parameters. Yeah, so we are not looking at macros. See, what we try to do is the moment you try to focus on too many things, yeah, your returns, you'll always tend to get biased and everything. Yes, as I told you, I was giving an example of 2004 to 2008. Of course, there are also many things that happen. Yeah, since you look at since 2016, yeah, demonetization, Brexit, yeah, US elections, Indian elections, yeah, many things, yeah, fragile five, all those things. But if you're confident about your stock, yeah, you need to hold on to it. If results are coming in good for your stocks quarter-on-quarter basis, or maybe if it's a turnaround story, you do it. And especially under this strategy, again, we are not looking at macros. I think, see, of course, that's a completely different form of investment, but we don't look much into macros across most of our strategies.
Right. So your asset calls are more, like signal based or something like that. If I've got that correct. Okay.
Yeah.
So
yeah, we are more of a bottoms up. Yeah. So just to give you a flavor, so see, apart from Phillip multi-asset strategy, we run Phillip Signature India portfolio, which is a multi-cap portfolio. Phillip Emerging India portfolio, which is a mid and small cap portfolio. We run a Sharia compliant portfolio. We run a ESG portfolio. We run a fund of fund portfolio. So, but across all the strategies, yeah, the idea is to, of course, identify the right stock, stay invested in them for a long period of time, and that is why, of course, if you see returns across all our strategies, we are amongst the top quartile as far as all our strategies are concerned. Sankalp, we can't hear you.
Sorry, I was on mute. So my next question to you is slightly on a very example-based kind of a thing. Okay, like actual instance,
Yeah.
like what did the like you touched upon it that during Feb second week you
Yeah.
had a sell signal and April third or fourth week you had a buy signal. So can you
Yeah.
just take us through each asset class that you have in your multi-asset portfolio and what were
Yeah.
these signals and what did you do like an actionable? What happened actually?
Sure.
So this will help investors
Okay.
get the flavor of the fund.
Certain. Yeah. See, as I told you, the fund is that way. It's very simple. Okay. The 50% is static. Yeah. The static is gold. Okay. International equities and that. Okay. So this 50% allocation is static in nature. The rest 50% that we invest into Nifty 50 and Nifty next 50 ETF, that is dynamic. Okay. And that is where our time tested algos come into picture. Okay. So what, of course, January, February was a big month. Yeah. January 20, February, initial first week, markets were doing quite well. It is then the news of the pandemic came in. Yeah, the infection was spreading. Of course, by then it was spreading in China a lot, but then it has started spreading in US and China and just started coming in India. So that is where the market started correcting. Okay. As I told you, through this algo, we are trying to time the markets a little bit here or there. Yeah, so it is not, we won't come to know, okay, this is the top, okay, this is the time to sell, this is the bottom, this is the time to buy. Okay. So I told you, yeah, so when markets were close to around what, maybe in February, close to around 11, 12,000 kind of a thing, yeah, Nifty, yeah, it gave us a sell signal in third week of February. Yeah, so what we did, we sold off the portion, 50% allocation that was to 30% to Nifty 50 and 20% to Nifty next 50. We sold off that. Yeah, we invested into liquid funds. Okay. Then of course we saw the big fall in the markets in the month of March. Again in April, first week, second week, third week, market started again going up, and that is where this particular algo gave us a buy signal around fourth week of April. Okay. And that is where again we sold off the liquid funds. We invested 30% into Nifty 50 and another 20% into Nifty next 50 ETF, and that is where we are riding the bull wave from there. So what we avoided was the big fall that has come in March. Yeah, close to around 40% fall that had come in March. We avoided that the entire fall. Of course, we missed out a little bit of upside in April for first 3 weeks, but that's okay. No one can time the markets exactly.
Right. So we will take questions on what is the current market flavor according to your algos. So if you have how much ever you want to divulge with us, what is your so the question is kind of a synonym for what is your market view currently, And
Sure.
the other question, very interesting question, which Mr. Vivek has asked us is, is why S&P 500 allocation is static? That's also an equity portion, and the algo should also be catching under or overvaluation with respect to international equities. So your take on that?
Okay. So see, this particular algo that we have developed, as of now, it only captures the Indian equity part of it. Okay. That is where the algo captures. Yeah. So it tells that where buy signal and a sell signal. So as of now, the remaining 50%, which is static in nature, so what we have developed a broad range out there, yeah, rather than using an algo. If it breaks any of those ranges, then we might use it. But the ranges are so broad, so we don't see maybe next 2 to 3 years those ranges getting broken on either side of it. So that 50% of the allocation to the three asset classes, which is namely debt, gold, and international equity, would stay there. What we are trying to see, trying to manage, is the Indian equities, and that is what actually we have seen the biggest reason for the drawdowns and volatility is Indian equities. Okay, and that is why we want to manage that volatility and the drawdowns. Yeah, see, when we had seen the previous slides when I was presenting, all other asset classes don't get that kind of a volatility and drawdown. Yeah, see, when I'm saying that asset is more volatile and it gets you more drawdown, so it also gives you an opportunity to make more money, provided if you are invested at reasonable levels. Yeah, so that is what we trying to do. And as far as your first question is concerned, I told you that from here on we are very confident about the markets doing well. Yeah, we might have certain bouts of correction here or there. Yeah, but over the next 1.5 to 2 years, we are very confident. What I see, yeah, see, if you go to see last 7 to 8 years, yeah, US markets had done very well. Yeah, I'm not talking about entire global pack. In fact, only US markets had done well. Yeah, and again in US, if you would invest in those 10-15 odd stocks, your returns would have been phenomenal. Against that, all your emerging markets had not done well. Yeah, and the currencies had also depreciated a lot. This is what I feel, and we have already started seeing the signs of it. Emerging markets will make a very big comeback, kind of thing. In fact, the currencies will also start appreciating a little bit from Europe. Yeah, and that is where all emerging markets would do well over the next 2 to 3 years. And I feel India would be one of the leaders as far as the rally is concerned. Yeah, but again, you need to be ready for a certain bit of correction here or there. But yeah, but again, the idea for us is when I'm talking about all my other strategies, we invest only into quality stocks. Yeah, so we don't go by the fad kind of thing. Yeah, that PSUs are working right now or cyclical stocks. We invest only into quality stocks because we are again seeing quality stocks would always do well over long term. Yeah, this cyclical stocks, or maybe they might have good upside in very short term, but therein you need to make two decisions, right? You need to buy at the right time, and you need to also sell at the right time. If one of those decisions is wrong, you would be kind of left with a very bad taste in your mouth.
So, Nishit, let me just tell you this. We did another poll with the audience. 47% of the audience feel bull run, so they concur with you over there. So hopefully it plays out well for all investors. So I have a question for you. In fact, one of our clients actually texted us this question live. So in a PMS structure, it is always said that it's a customized structure where you hold units in your own DP. You hold stocks in your own DP instead of units. So this is a PMS structure where you essentially have units. So the beauty of a PMS structure always has been that it helps you buy actual stocks or businesses, so that whatever happens in the market, it doesn't in a way affect you. Okay, but the instruments you use here are more, for a lack of better words, social in nature. Okay, so they're ETFs. Okay. How does that change PMS as a vehicle, or what it does to that vehicle? Over to you.
Sure. Okay, so see, across all our strategies, so unlike most of the other PMS providers, we don't have a single model portfolio that fits everyone. Yeah, so we customize each of our clients' portfolio. In any of my other strategies, which are bottoms-up approach kind of a thing. Okay, so we customize each of our clients' portfolio. As you rightly said, the stocks, whatever we buy, are in the demat account of the client. So here also the units, whatever that we are buying, are in the demat account of the client. Yeah. So it is not at the pool level or something that we keep the units kind of thing. They are held at the demat account of the clients. Yeah. See, again, when we try the entire idea of this product is that we wanted to make it very low cost. Yeah. One, and also at the diversify kind of thing. Okay. So when I'm investing into Nifty 50 ETF, I'm diversifying across 50 stocks kind of thing. Yeah. So that is the idea kind of thing. So if I try to, rather than in ETF, I try to invest only into 8 to 10 stocks. Again, the entire idea of this product is getting mitigated because the idea is diversification. Yeah. So it is not only across asset classes, but within those asset classes also, again, across multiple stocks kind of thing. Yeah. So it is very transparent. Yeah. As you rightly said that PMS, yeah, the units are held in the name of the client. Yeah. And as far as the fees and everything is also concerned, I see a few of the guys are asking questions on the fees. Of course, you can get in touch with us, but I can assure you there are more performance linked as well kind of thing. So you need to get in touch with us, and of course we'll be more than be helpful to not only answer about this particular strategy, but any of other strategies as well.
So, I was actually coming to the fees and the performance part of it. So, as we close, if you can just tell us about the performance for the last whatever period that the strategy has been there, or back tested numbers, and just just a hint on the fees if you deem fit. So, yeah, over to you.
Sure. Of course, as far as the fees concerned, of course, we would like to maybe the clients prospects can get in touch with us. But we have both the fee option. One is a fixed fee option and one is the variable fee option. The variable fee option has a kind of a structure wherein the better the returns are, the higher the performance fees would be kind of thing. So we have both the structures, but it is not very high because again the entire idea of this product is to keep the cost down kind of thing. And
sure.
So that is one of the
So with regards to fees, you can write to us, we'll get back to you.
Certainly. And the second thing is, as far as the performance is concerned, of course I showed you that we have back tested since 2013 kind of a thing, 2018. What have been the returns been? And we have seen that they have been much better kind of thing. But again, this are only back tested numbers, guys, please. And we are not giving any kind of assured or guaranteed or returns, or maybe we are not even saying any indicative returns kind of thing. So you need to do your due diligence out there. But again, this product is well tested kind of thing. And we have seen, even if you do a simple diversification, your returns improve. And if you try to manage the volatility that Indian markets get in, your returns will be much better.
Right. So thank you, Nishit. So we'll just take this last one question, which is actually quite interesting, and then we'll close today's session. How is the taxation going to be on this fund? Because this has at least 4 asset classes. So there's international equities also. So if you can just put in a word or two over there, that will be very helpful to investors today.
So again, we are in the taxation actually is in favor of the clients. Unlike maybe a multi-asset mutual fund, which some of the mutual fund companies have launched, therein it is debt taxation. So your taxation would tend to be higher. Here, 50% of the allocation which is towards Indian equities, therein long-term and short-term taxation would be there, and the rest 50% which is into gold, international equity, and debt, therein debt taxation would come. But again, I am no expert on taxation part of it. Your CA would be the best kind of. He would be able to give you the best kind of an idea out there. But this is what we understand, that again this particular structure has a better advantage over what normal multi-asset mutual funds would have.
Right.
Apart from, of course, the returns tend to be better, and of course your taxation also might be low, but you need to check with your CA.
Sure. Thank you, Nishit, for being with us today. Thank you to the audience for being with us. So actually, this is a very interesting session we had today. We talk about asset allocation all the time, and here's a fund which actually lets you implement asset allocation in a very rule-based way. So thank you, Nishit, for being with us today. Thank you, Phillip.
Thanks.
And to the audience, if you have any question in regarding to the strategy, please do get in touch with us. I will leave my email ID in the comment section, and you can get in touch with us. Thank you, Nishit.
Yeah, thanks, Sankalp, and thanks everyone for attending this. If you have any questions, of course, you can get in touch with them or us. That's not an issue. Yeah, and please, guys, please stay safe. Please try to wear a mask whenever you step out, kind of thing. Yeah. Again, the cases are going up, so I would strongly urge everyone. Yeah, please do take care of your health and of your loved ones. Yeah. Thanks,
Thank you,
everyone.
Nishit. Thank you.